Way to start the new year.
Well, if only the first day of the year set the tone for the rest of the year, because it was a great day today. The market up over 1%, above 4,700 on the ASX 200, fresh 19-month highs. And really, with a risk-on environment like we saw today, with commodity prices higher as well, as expected, the materials and cyclical sectors were the big outperformers. The materials sector was up over 2% today. Big gains across the iron ore miners again as the iron ore price continues to surge. Fortescue up almost 6%, Mount Gibson Iron up 7%, Rio and BHP both putting in good days as well. Even the serial underperformer Newcrest Mining in the materials space managed to gain over 3% today. And a sector that was largely forgotten through 2012, the industrial sector, up 1.6% today. So a very good day. Volumes came back a little bit, over 2 billion traded, bouncing back from those very low volumes over the holiday period. But the ASX at the moment just appears to have some very good positive momentum behind us. If you look at any of the moving averages, they're all trending higher. Some of the momentum indicators, such as the relative strength index and stochastic index indicators, are both very strong and positive at the moment as well. So around the region, Asian markets were all in a very good mood today, and the Australian market does take a lot of leads from the region. So we saw the Hang Seng hitting new highs, the Nikkei hitting fresh highs on Monday when it was open. So really risk currencies as well performing very strongly at the expense of the US dollar.
John, we were talking suggestions, technically at least something just below 5,000 before we hit any sort of major obstacles. What could potentially be, I suppose, some issues fundamentally? A lot of talk about, the upcoming reporting season is going to be pretty important in terms of the outlook for our markets.
Yeah, absolutely. I think earnings will be very key in 2013, but there are a few headwinds probably facing the Australian market through 2013, which may prevent it see the same kinds of gains as 2012. I think earnings certainly will be there once that reporting season starts in February. Across 2012, particularly materials and sort of energy sector earnings were particularly disappointing with the fall off in commodity prices. They should probably improve a little bit through 2013, but I think the earnings across 2012 overall were a little bit soft, and through 2013 I think expectations are only around 2 to 3% growth across the Australian market for earnings. So for the share market to go higher, there's been a lot of talk about the market going higher on PE expansion, but I think there needs to be some earnings really come through in the market and some top line growth, because companies have really been looking to cut costs to improve profit lines, but really revenue growth hasn't really been there in the Australian market. So I think earnings will be very important through 2013.
Look, where would you expect to see, or at least hope to see, some of the positive movements in regards to share prices? I mean, 2012 seems quite conspicuous for the absence of the miners getting in on the party, all the money very much flowing into the likes of the banks, Telstras, these guys that have seen more safe havens and sustainable dividend yields. Does that continue, or do we start to see some of these cyclicals find a bit of favour?
Was that to me, sorry?
It was.
Oh, sorry. Yeah, I think it certainly will. The cyclicals will come into play 2013. There's a lot of people still talking about the defensive and the yield plays continuing to be supported in 2013, but yeah, I seriously don't think you can expect to see the same returns in the banking space and the healthcare and the defensives as was seen across 2012. I mean, financials are up over 20%. I mean, the banks do make up a large market capitalisation on our market. The big four banks alone do make up about a quarter of the market capitalisation. So if there is going to be money coming into the equity market, some of it will find its way to the financials, obviously, and that will be supportive. There'll still be investors looking for yield in the market, so it will support. You might look at some of the underperformers as the ones that will outperform. Someone like a NAB that only managed a 5% gain in 2012. If investors are looking for yield, they might look at the ones that haven't run so hard. But I think the outlook around the world in terms of growth is starting to look up a little bit in 2013. That'll be supportive of the materials and energy space. The energy space had a very disappointing 2012. The oil price struggled in 2012, down around 8%. So if the oil price can come up a little bit, as a lot of people are expecting, maybe the energy sector as well could be in for a good year.
Is this going to hang over the market? Is this going to be the next issue, if you like, that investors are going to be eyeing off and pricing in?
I really do think it is. If you look at the deal that's done today, it was pretty much as the market expected, a short-term delay, really. And the debt ceiling negotiations, I think, have been accepted as many as what's going to be an actual tougher negotiations for agreement to be reached on. And on one side, you've got the Republicans looking for significant spending cuts, and any increase in the debt ceiling there, they'll be looking for some kind of commensurate sort of increase in cut in spending to match that, while on the other hand you've got the Democrats who will be also looking for new revenues through tax reform and things like that. So there's going to be considerate disagreement there and significant negotiations that are going to have to come through. And the impact on the market, I think you'll be able to see it back in 2011 when they were going through these US debt ceiling negotiations. Eventually, when they did come to agreement, the next week Standard & Poor's downgraded the credit rating of the US for the first time ever, and we saw the volatility in the market just increase substantially. I think the US market had the most volatile week since the 2008 and the GFC. The Dow dropped something like 600 points on one particular day after Standard & Poor's cut the credit rating. So I think definitely in terms of the US credit rating, that's going to be important moving forward, and what this debt ceiling negotiations will mean there as well.